Good morning, everyone, and welcome to the Money Control live stream. You're watching Markets with Santo and CJ. Well, in case you have not noticed, the global economy is going through its first ever full-blown energy crisis, a crisis that has been triggered by years of low investment, Russian sanctions following the country's invasion of Ukraine, and soaring power demand due to climatic conditions. Now, if you look at it, Santo, at this point of time, I think that the market that encapsulates all of this is the natural gas market right now globally. Natural gas supplies have been shrinking in some places artificially, in some places because there are low investment. And that is pushing prices in Europe, in US, and even in Asia to near record high levels. If you look at the European case in particular, Santo, European prices at this point of time are quoting near $70 per British thermal unit. That is almost 9 times the $7 per MMBTU that is quoting in the US markets, right? And this is largely because Russia, which is the major supplier of gas, that has cut off most of the supplies to the European continent, and that is pushing supplies lower and demand higher. Because of this, a lot of industries are suffering. We have already had BASF, threatened to close one of the largest chemical complexes in the world in Germany. Already some aluminium smelters have also been shut down, and that is now triggering a supply squeeze in some of the product markets or commodity markets such as aluminium, zinc, and who knows what else going ahead. So clearly, Santo, could natural gas be the trigger for the next revival in commodities market?
Well, at this point, CJ, it still looks as if the secular uptrend that you had seen in commodities across the board, you probably may not see that. It could again be restricted to certain sectors right now, like we are seeing that for gas going up sharply, aluminium, zinc. But if you look at the outlook for something like, let's say, ferrous metals, steel, it's not very positive at this point in time. Again, if you look at crude oil prices, the outlook is kind of mixed. Crude oil prices have come off a little bit, and they seem to be alternating between the story of supply shortage and global slowdown. Every time the talks of global slowdown gain the upper hand, you see prices coming off. Then a few weeks later, again, market comes to the view that probably there could be a supply shortage which could continue, supply disruption, and all those things could keep prices higher. So it is still a mixed bag. But one thing is for sure, the renewed spike in commodity prices, that's definitely not good news for equity markets globally as well as locally.
Because you're worried about inflation.
Clearly inflation, and if you see the rally in many of the sectors, like just a case in point is auto, based on the fact that commodity prices are going to cool off, right? And now if you see commodity prices moving up again, you could see that thesis being tested. Again, will this really help the commodity players also? That's the other question to be asked, because you've seen that in March when prices shot up very sharply, they did not sustain in most cases, which means there is a pushback at higher levels from the consumers as well. So on one hand, you have prices moving up once again, but at the same time, it could hurt demand, besides making investors worry about the consuming sectors as well, since commodity prices are rising. So this is a kind of rise which really does not help anybody's case.
I think Santo, the big crux of it is that being a businessman in this environment is very, very difficult, because you have 2 months of soaring commodity prices, then 3 months of plunging commodity prices, then again a revival on the offering. But at this point of time, I think the oil and aluminium markets are 2 markets probably which could push other markets also towards a bullish scenario going ahead. Clearly, oil prices have now rebounded almost $5 to $6 per barrel from the 6-month low of about 91.4 that it hit not so long ago. Citi, yesterday we mentioned in the show that Citi expects oil prices to go back to the $125 per barrel range not so in another 6 to 7 months. So clearly, there are people out there who are bulls on the commodity market, and we generally know that when oil performs well, rest of the commodities tend to follow. So that will be my limited argument. I think as far as ferrous is concerned, I think back home there is expectation that probably government sooner or later will remove that that export duty tax that had been imposed on the steel sector. That would be very critical for the revival of the steel space as far as India is concerned. And interestingly, Santo, yesterday Incred Equities came out with this report, and they had this thesis, and despite the correction and whatnot that has happened in metal stocks, they had this thesis that probably commodities could be starting a new long-term bull market. So, I mean, the house remains divided, but you have to be very positional in terms of where you take your positions.
Well, I'll just make a quick point about the ferrous part which you mentioned, and then you could move on to the market segment.
Yeah.
Well, CJ, when we say the tax being withdrawn, we're talking about the producers, and their margins.
Yeah.
The fact also remains, which even some of the steel managements have said, the demand has weakened both globally and locally. So even if you're getting better margins, it's still the volume growth is a bit in question.
Yeah, but the only thing would be that probably demand is still better than where it was in 2021 or in 2020, right? I mean, of course, the reopening had given a big push to global demand, but we would have anyway expected that to normalize in 2023, 2024. So it remains to be seen which way it flips for the commodity stocks. But the only thing is in favor of commodity stocks is that their balance sheets are much stronger this time around than say 5 to 10 years ago. That said, let's now move on to the trade setup for today, and clearly it looks like a very muted day, a very muted Friday on the Wall Street. If you look at the XGX Nifty, they're indicating almost a 40 to 50 points cut on the benchmark indices when they open at 9:15. Overall, Wall Street, however, gave a positive handover to Indian equities. Nasdaq benchmark indices there closed higher, largely on the back of some positive economic data coming in. Initial job loss claims had fallen. Even the Philly, business sentiment index has also risen. So clearly, some bit of positive news coming in from there. But the only concern for an emerging market equity like India, Santo, would be the fact that the US dollar index is now at a 1-month high.
Well, that apart, again, you're not seeing consistency in FPI flows. Yesterday, they were net sellers. Now, again, we don't know if this is a one-off case.
Yeah, I think it would be one-off because, the Sona BLW, block deal probably pushed it towards the net seller side. If you take that out, probably there were net buyers of about more than 1,000 crores.
Well, we can slice and dice the numbers whichever way, but at the end of the day, is money coming in or money going out? That's the question you need to ask. That said, probably at this point, downside still looks limited. Market appears to be comfortable. As on the whole, they appear to be comfortable with valuations. And at the same time, even on the charts, most stocks, the key stocks at least, are showing good strength.
Yeah, I mean, if you look at the BSE 500 Santo, almost 50 to 60% of the stocks are now above their 200 DMA, which goes to show that there is quite a good momentum out there in the market.
Well, with that, let's get into the stocks on our watch list this morning, starting with JK Cement. There's been an outperformer in the cement segment, almost nearly 40% rally over the last couple of months. Good set of first quarter numbers, that's been one of the major drivers. But if you look at the numbers, it's the beat in profit after tax has come largely to control of costs. Now, the company had access to low cost fuel, which helped it report good numbers. Now, that may not be there in the second quarter. The company has already said that prices of fuel, it will be using the high cost inventory now, which will put margins under pressure. In fact, the management has said that there could be as much as a 30 to 35% dip in EBITDA margins.
Right.
That apart, its volume guidance is 10% growth for FY23, and if you take away the first quarter, that means 8% volume growth for the rest of the year. Most importantly, cement prices have been under pressure both in the north and south markets in the first quarter. All these factors considered, at least in the near term, probably you may see this outperformance streak ending.
Yeah, probably. I think after a rally of almost 40%, you would expect any stock to probably have some bit of consolidation, because you want to see whether that rally had some meat in it or not. But I think, Santo, as far as costs are concerned, even if the management had guided, of course, that the September quarter would probably see cost pressures rising, I think the view among analysts is that probably the cost pressures will peak in the September quarter, and therefore going ahead from December and March quarter onwards, you could see a sequential decline. Maybe on a year-on-year basis, you could still see those pressures, but on a sequential basis, you could still see a decline because, of course, of the fall in oil prices that we have seen over the past 2 to 3 months. Therefore, of course, that should help margins revive at least after the September quarter numbers on a sequential basis. Now, as far as the volume growth is concerned, yes, it seems a little muted, it seems a little moderate, but I think given the fact that government capex is still to come in a big way and the monsoon season will be over, I would not be surprised if we see a faster growth rate in volumes in the second half for cement industry at large, not only JK Cement, but the cement industry at large. And I think north and south, of course, these are markets which have been affected by a lot of excessive flooding as well and excessive rains as well during this monsoon season. So that could be probably one of the reasons why we have seen some moderation in volume, but I would expect that to correct probably in the second half. First stock on my radar today is from the metal space, of course, ONGC. If you look at ONGC, the government last night has slashed the windfall gains tax that was imposed on crude oil producers. They have brought it down to about 13,000 rupees per ton from about 17,700-ish earlier. Now, this should be incrementally positive for the stock. I think, Santo, yesterday we saw quite a sharp decline in the stock, but today I think we could expect a good rebound on the back of this government measure. Overall, globally also, we talked about it earlier, there has been a decent rebound, and I would be interested to see if now oil prices go ahead and move above the the $100 per barrel mark. If that happens, then that could revive some of the sentiment that we have seen in ONGC that has become lackluster over the past 1 month. And overall, I think, Santo, for FY23, optimism still remains that earnings growth will be quite strong.
Well, CJ, probably you could see a brief bump up in ONGC today, more of sentiment led. But at the same time, investors are not going to really stick their necks out, because they are now of the view that oil is one sector where they will have to live with constant policy interference. We have seen that both in the case of oil marketing companies as well as upstream companies like ONGC, Oil India. There is just no clarity, visibility on earnings, which means that if companies start doing well again, crude prices inch up, again the windfall tax will be imposed. So that being the case, maybe there could be a strategic play on the stock for the time being, but unlikely that it will be lasting. Next stock, Insecticides India. Again, good performance by the stock on the back of a strong first quarter numbers. The numbers were largely driven by new product launches and a strong performance in its herbicides division, which recorded close to about a 44% revenue growth. Now, the company's capex program at Rajasthan and Gujarat both are in its final stages, and according to analysts tracking the stock, the big triggers for volume growth going ahead are new product launches. Besides that, they are also positive that the margin profile of the upcoming in molecules which they will be in licensing, that is also supposed to be much better. So these are a couple of factors which are in favor of Insecticides India at this point in time. And also, CJ, both FPIs and FIs have increased their exposure to the stock during the June quarter.
Interesting. I think it's a decent stock, Santo, within the entire agrochem space. But for me, I think at this point of time, I'm a little dicey on the agrochemical space in general, given what is happening globally as well as domestically in terms of climate change, the impact that it will have on sowing patterns. You're already seeing that reflect with the paddy crop this year, wherein in places where monsoon, you would expect normal monsoon, there has been erratic monsoon, and therefore paddy sowing has actually been down 13%. Then in other parts of the country, you're seeing excessive rains and flooding, and that has led farmers to almost go for a second or third or even fourth sowing in some regions. So probably I'm a little cautious this year in terms of where the agrochemical industry may come out. I think you would get a clearer picture on demand side in the September quarter, and after that we can take it from there. But at this point of time, I would probably be a fence sitter on the stock. Last stock on my radar today is Hindalco. Well, of course, we spoke about the aluminium market, the surge in aluminium prices that we have seen internationally. Now, that is a very key trigger for a company like Hindalco. Let's not forget that the company has also done well after the June quarter earnings, because the earnings were quite strong. Before we carry on, Santo, let's quickly take a look at how the market is shaping up this morning, and surprisingly, it's been a positive start.
Steady start there. Again, good breadth there. Second line stocks doing well. Close to 1470 stocks are up, and less than 400 stocks are down at this point in time.
And the bulls are having a party, Santo. There is nothing that can deter them. Even the US dollar index at one point of time was making them nervous. Now, a 1 month high US dollar index is not a thing to be concerned about for the bulls at this juncture. If you look at, Santo, the mid-cap space is where you're seeing most of the gains. The Nifty mid-cap index is higher by about 0.3%. The Nifty small-cap index higher by about 0.25%. And the India VIX again is weak, is down about 1.9% at this point of time. So clearly, a very decent start compared to the cues that we had earlier this morning in terms of the HDFC Nifty. Now, Santo, coming back to Hindalco, why I brought this stock into notice is that the Q1 earnings were quite resilient, of course, led by Novelis Corp, which is a subsidiary. But overall, also, if we see a revival in aluminium market, which was anyway expected to be quite tight, I think this is one stock that could surprise the market, given the sort of beating it has taken throughout the year.
Well, something similar here, like in the case of JK Cement, which I had been mentioning, the operating costs, the company has clearly indicated that for upstream alumina will be higher during the second quarter. In the first quarter, they were still lucky, they got away with it. In the second quarter, the operating costs will be higher because of higher fuel prices.
Yeah.
Besides that, the average aluminum prices for the first quarter was around $2,800 per ton. And this quarter, unless now we see continuously the prices inching up, the outlook is about 2,400 per ton. Okay, so now you have high fuel costs and you have also the aluminum prices which are going to be lower than the first quarter. Of course, that situation could still change.
Yes.
We're not very sure
because
about
we are
that.
still almost 1.5 months away
So
from
the
end of the
Novelis
quarter.
side of the story is pretty known in that sense. They have upgraded the EBITDA per ton to about $525. That the industry which Novelis caters to is recession proof. So that story is well known. But you're clearly going to see pressure on the upstream alumina business this quarter, and that again could limit upside. So I think a lot of it probably could be factored in the stock price at current levels. A bottom definitely has been formed, but how much can the stock climb from these levels is the question I would ask.
I think, Santo, the way the market will look at it is that if aluminium prices crashed in the June quarter and you see the maximum impact in in the September quarter, then the surge in prices probably in the September quarter, we have to still wait and see whether it sustains or not, could start reflecting in the December and March quarter. So I think it would be a long game that probably investors will try to play at. But at this point of time, at least from a tactical point of view, this stock looks quite interesting given the fact that valuations have actually gone quite considerably below the mean that or the long-term average that the Hindalco has. So good, I think it's something to watch out for. Keep it on your watch list and see how the price action shapes up.
Well, last stock on our watch list this morning is Titagarh Wagons, a company which has been underrated and ignored by the market for quite some time.
For some reason.
Yes, but the fortunes of the company has been changing over the last few months. If you notice, the stock has rallied more than 60% from its March lows, and there is a reason. Now, Titagarh Wagons was primarily into making goods wagons, right? But now it's also won a order for the Pune Metro, and it's bidding there in a big way. Also, it is now trying to shift focus to passenger coaches as against just purely goods wagons. Now, in the case of goods wagons also, the railway is planning to buy about 90,000 wagons over the next 3-4 years. That is like a huge 35,000 crore order, and Titagarh already has bagged about an order of 24,000 wagons, and its production capacity is about 4,000 to 5,000 wagons per year, which means that its order book is pretty strong for the next few years. Around 14,100 crore is its order book at this point in time. Besides that, it's diversifying now into passenger coaches as well. It's bidding very aggressively. And you've got the railway capex program also in a big way. Railways plans to launch about 400 Vande Bharat trains over the next few years. That is another 45 to 50,000 crore order size market for companies like Titagarh Wagons, which caters to the railway industry mainly. And lastly, it's also developing propulsion systems for electric motor units of Indian Railways and getting into shipbuilding as well. So it's a diversified play at this point in time. It's still early days probably, but the market now seems to be looking at the stock afresh.
I think, Santo, probably, I mean, as you said, of course, if the outlook is changing, I think that is why you're seeing the sort of rally that we have seen in the stock. My only few concerns would be, of course, on the operating performance, because that was quite weak in the June quarter, and given that costs are expected to remain high in the September quarter, that is something that probably might limit the upside in the near term. And lastly, I think the long-term growth, I mean, these are stories that we have heard about railway capex in the past as well. I mean, back in the days when there used to be a railway budget, you would see stocks like Titagarh Wagon getting very excited about the plans, but ultimately the growth always used to falter and disappoint. So I would be a little cagey on the long-term growth outlook still. Yes, maybe the railway plans to do all of this, but we'll have to wait and see when the order is tendered, if the tenders are brought out, and if Titagarh ends up bagging all of those orders, right? So I think, yes, there is signs of improvement, but probably not so much that you go whole hog on a stock at this point of time. I think, Santo, one of our viewers want to have your thoughts on one stock that you have been talking about quite a lot earlier as well, and that is HDFC AMC. Abhishek Ranjan wanted to know about HDFC AMC. This is one stock that has seen some bit of revival the past 2 months. I think we touched upon this stock earlier this week as well. What do you think?
Well, I think at this point in time, a temporary bottom appears to have been made. You saw the stock fall all the way to around 1700 level and then bounce from there. But again, it could be a very slow road to recovery is what I feel, because the AMC still has to show that it can improve its market share considerably, improve equity assets under management. Also remember, we are moving into a slightly tricky phase for the equity market. We've had a good run over the last couple of years. Here on, gains could be a little muted. As long as the market is rising one way, you have steady money coming into mutual funds, but this fresh money has not really been tested. So that's my only concern at this point in time. I would put it this way: the downside looks limited, but I guess it could be some time before the stock is really re-rated by the market.
Yeah, I think it will be interesting to see. For me, I think it will be interesting to see how the performance goes from here on, because the recent revival, of course, in the equity schemes for the company has something that's been talked about by the market. But let's not forget that the leader of the pack has actually left now. And the exit of Prashant Jain as CIO has now happened, and of course they have internally promoted candidates at this point of time. They have made a head of equities and a head of fixed income, and it will be interesting to see how that dual investment head system works. It has worked successfully in the past in some places such as SBIMF, but it has probably faltered in other places. So it will be interesting to see how that dynamic works out and whether that makes market happy going ahead, and that will have a big say in how the stock performance is.
Well, with that, it's a wrap on this edition of Markets with Santo and CJ. Thank you for watching, and do let us know what you thought about this show. Please post your feedback in the comment section below.
And as usual, guys, keep following us on the social media links that you can see at the bottom of your screen. And for rest of your financial news, stay tuned to moneycontrol.com and download the Money Control app. We'll catch you again live at 3 p.m. with all the day's action. Till then, have a wonderful trading day.